What's up, everybody? Nate here. And the Federal Reserve for pretty much the last year or so has been heavily talking about rate hikes and bringing down inflation in our economy. And as of March of this year, they finally started to raise interest rates. And as of the last couple of months, we have seen inflation slow down in our economy. But now it looks like the UN and other economies around the world are actually asking the Fed to pump the brakes.
Can you please slow down?
According to a new report from the United Nations, they believe that if the Federal Reserve does not completely stop raising its interest rates right now, or at least drastically reduce the amount that they're going to raise them by, we could see a very big and prolonged global recession. In addition, they believe that central banks all throughout the world should also stop raising interest rates, as this is not going to be the ultimate solution to inflation or fixing our economic issues as of today. So with all of that being said, I want to talk about the UN's comments here. I want to go over how interest rates actually help inflation, if stopping them or starting them is going to cause an economic collapse, and what we can expect to see from the Federal Reserve in the future. All right, so today I want to start with a few quotes directly from the UN themselves. So they recently said, quote, "Excessive monetary tightening could usher in a period of stagnation and economic instability." In addition, the UN said, quote, "Any belief that they, the central banks, will be able to bring down prices by relying on higher interest rates without generating a recession is an imprudent gamble." And finally, they said, quote, "If you want to use only one instrument to bring inflation down, the only possibility is to bring the world to a slowdown that will end up in a recession." All right, so let's go ahead and unpack this. Kind of get you to understand exactly what is going on here. Let's start at the bottom and kind of work our way up. So the Federal Reserve is the central bank of the United States. They control most of the monetary policy, and one of their big monetary instruments is interest rates. Interest rates in our economy control all sorts of things because that determines how much borrowing is going to happen in our economy. Essentially, how it works is the Federal Reserve is in charge of telling the Treasury Department how much money actually needs to get printed, and then the Treasury Department takes all of that money and then loans it out to banks and financial institutions and businesses and anyone else that needs money, bondholders for instance. So now all of that money is in circulation, but when banks get this money from the federal government, they pay a particular rate in order to get it. That's why when banks get their money and then they give it out to people, say for a mortgage or an auto loan, they make it a whole lot harder for you to use it by raising interest rates. They actually want to make more money because they had to pay money in order to get that loan. So when the Federal Reserve raises its interest rates, that makes it a whole lot harder for banks to get their money. And when banks have a hard time getting their money, they're going to make it a whole lot harder for you to use their money. So borrowing goes down throughout the entire economy. People are not able to get mortgages as easily. You can't buy a car as easily because people don't have tens of thousands of dollars to spend on a car or on a house. So you have to get a mortgage, you have to get a loan. And not only that, but other aspects of our economy start to slow down too. Like businesses start to slow down because investors and people who need to take on debt for those businesses are not able to take on that debt as easily because it's so expensive to do so, and investors want to see a profit or a return on their money. So if they can't get that because interest rates are so high, then they're not going to invest in businesses. That ultimately leads to an entire domino effect in our economy. Now businesses don't have as much money or liquidity to grow anymore, so they start to slow down. And when businesses slow down, they still try to continue to be a business and try to continue to be profitable, so they try to cut costs every single area that they can, and that usually involves people. Depending on how high interest rates get, well, that could mean unemployment goes way up in the United States or another country that has really high interest rates because it's harder for everybody to use money. So when we say it's really hard for people to use money, what does that really mean? Well, this means that the dollar is really strong and it's deflationary rather than inflationary. We have had an inflationary economy over the last 2 years or so because the Federal Reserve had really low interest rates. They wanted people to go out and easily be able to get a mortgage or an auto loan, or businesses to expand, because we needed all of that money in our economy, at least from their perspective. We didn't know what was going to go on with the pandemic, so that's why the government printed so much money and the Federal Reserve Reserve lowered their interest rates. When you have an inflationary economy, everything goes up because there's so much money in circulation, right? So now people are spending a whole lot more. Businesses have higher profits because there's all of this money going right back into the economy. When you have a deflationary economy, though, that is the exact opposite. Now your dollar is really strong. All of the dollars in circulation are really strong because we're not really printing as many and there's not as many in circulation anymore. That's exactly what the Federal Reserve can do with its interest rate monetary tool. It can spark demand in our economy and it can reduce demand. Sparking demand means lowering interest rates and reducing demand means raising them. So now what exactly does this mean on the global scale, and why exactly does the UN care what the United States does with its monetary policy? Well, you got to remember at the end of the day, the United States dollar is the reserve currency of the world, and emerging markets and a lot of other big economies take on a ton of US dollars. When the US dollar is really strong, that means it's harder for other countries to circulate the rest of their dollars. Countries that take on US debt or take on US capital are going to have a lot harder of a time getting US dollars right now, which means those economies are also going to start going down. And not only that, it pushes investors in other economies away from those other currencies and it pushes them towards US dollars because US dollars are a whole lot stronger and they're seen as a safer bet for a lot of investors. Investors are not going to want to put their money into an inflationary currency and they're not going to put their money behind something that is going to constantly be losing their value. So they're going to seek the United States dollar as a safe haven, and as more investors put their money behind US dollars, that means the US dollar just gets stronger. Not only that, but the monetary policy that the United States sets and the Federal Reserve actually creates does matter for a lot of other economies, especially businesses abroad. As these global companies start trading and dealing in United States dollars, well, they are going to see a lot lower profits because the United States dollar is so strong. And the ultimate reason that you need to understand here has to do with spending. So in the United States, as all of these interest rates go up, people are not going to be spending as much US dollars. So the fact of the matter is US dollars are harder to come by, meaning the US dollar gets a whole lot stronger. And the same can be said for other businesses abroad. They're not going to be getting as many US dollars that they rely on in order to grow their business. They don't want other currencies though, because those currencies are highly inflationary and they'd be a whole lot worse off taking that money. So they're going to continue to take US dollars, but there's just going to be less of them, which is going to hurt the businesses and it's going to hurt the economies and markets abroad. But this is also a systematic problem for every single government throughout the entire world, because when the United States starts raising its interest rates, a lot of other central banks start raising their interest rates too. And this is something that we've seen pretty big over the entire planet because a lot of economies have an inflation problem, like in the UK. Their inflation rate is arguably higher than the United States is, so they want to bring down inflation too, so they're also starting to hike their interest rates. If all of these countries hike all of their interest rates, then no currency is safe. And ultimately, investors are not going to be investing as much money. That is just bottom line, and the only thing that these businesses can rely on outside of that is sales. They have to sell more products, they have to have more services, and well, people are not going to be able to spend as much money because of high inflation and it being really difficult to come across any currency. So there's just going to be a whole lot less spending. I want to talk about the other concern here from the UN. They believe that raising interest rates in general is not going to solve the root issue of inflation in general. And to be completely honest with you, the UN is right here. Federal Reserve Chairman Jerome Powell has actually stated this many times. Is raising interest rates going to bring down the prices for food, which is one of the biggest inflationary items that we have seen over the last year? Is it going to bring down prices in shelter? Is it going to bring down prices in energy? The short answer is absolutely not. And that's because you got to remember what these interest rate policies are affecting. They are affecting people trying to borrow money. That means investors, that means people looking for a mortgage or an auto loan. They are affecting those people, and it's making it harder for people to borrow money in general. we are going to have a credit problem because of that, but it doesn't really directly affect anything else in our economy. So then why exactly is the Federal Reserve raising its interest rates if they don't work? Well, because the Federal Reserve is in charge of our monetary policy, and this is the only thing that they can do. The Federal Reserve wanted all of this money printing between its quantitative easing program for Wall Street, which, by the way, they're also slowing down massively, which is causing less liquidity for markets in that way, but because they also lowered their interest rates. The Federal Reserve is supposed to be an independent entity from the United States federal government. Obviously, there is a ton of influence the United States federal government has on the Fed, but it's supposed to be its own thing, meaning that it makes its own decisions, an unbiased decision on what to do with its monetary policy based on our economy and inflation. So in other words, it heavily contributed to this problem by printing trillions of dollars in money and then lowering its interest rates for arguably way too long. Now it's got to turn everything off and completely flip the script and raise its interest rates so that it can bring inflation down again, but that's not going to bring down the prices of food or energy and shelter directly. What it's going to do is mean that investors don't invest as much in businesses. Businesses will shrink, they will cut employees, and now people will be out of jobs. And if people are out of jobs, they're not making as much money, meaning they can't buy as much. So that demand then gets sucked out of your economy. Obviously, that could lead us into a recession, and that is exactly what the UN is worried about for all countries throughout the world. They don't want all of these businesses to get hurt and all of these people to suddenly lose their jobs. People that have mounds of debt has started to rise quicker than pretty much it ever has over the last couple of years, and if people lose their jobs, they're not going to be able to pay all of this debt off, and they're not going to be able to buy anything else to stimulate their economies. That is all bad news, and you got to remember, inflation is not just one issue. It's not just money printing. That is a big part of it, but it's also a bunch of other things like supply chain problems, corporate greed, and a lot of over speculation in a lot of industries. The UN believes that if the United States really wants to bring down inflation, it can do that through legislation. It could try to make some of our supply chains a lot more efficient so that way we can get more things out to the people that really need them, and they can crack down on things like price gouging. Raising interest rates will absolutely bring down inflation, but it could also cause a global recession if the Federal Reserve is not careful. That's because it really has no other choice to. This is basically like a burn your bridges kind of policy from the Federal Reserve. It'll get the job done, but not without some serious consequences. And I will say too, legislation is not a guarantee to bring down inflation. I mean, when you have a bill, a lot of the times you have to increase taxes. You have to take taxes from something else in order to pay for, say, your supply chains, or you have to print even more money to make the country even more efficient. So that has its own problems as well. That is not a perfect solution that the UN is proposing here. You definitely need a balance of both, but the bottom line is the Federal Reserve has been extremely clear about this. They are going to continue to raise interest rates aggressively and quickly for pretty much the next year or so until inflation starts to noticeably come down in our economy before they even think about stopping or actually lowering interest rates again. They want to get inflation down to around 2%. And remember, right now it's at 8.3%. So they've got a long way to go. But now I want to hear from you on this issue. What do you think about the UN and their plea to central banks like the Federal Reserve to stop raising interest rates immediately? Do you think that the Federal Reserve is going to raise interest rates and cause a global economic recession? Or do you think that the Federal Reserve is just going to bring down inflation and our economy, especially across the world, is going to be just fine? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel. I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.